Alright, what's up guys? Today I'm be basically going over fair value gaps. I'm gonna tell you guys what a fair value gap is in this video, and I kind of want to show you guys in another video how I play fair value gaps. Obviously, I use like fair value gaps as kind of like entries or like kind of more like indication of like trying to catch like my reversals, or when I'm playing my break of my range, I'm gonna try waiting for like a retrace back into a fair value gap and then kind of continue to whichever side it's going. Um, and then again, if I'm trying to catch a reversal to the upside, I'm going to want to see a fair value gap get inversed. And once that fair value gap gets inversed, then that's called the inverse fair value gap. And then I'm going to be trying to play the downside. Obviously, depending how you're trying to play the market is how you should use your fair value gaps. Overall, if you see a bullish fair value gap, you're not gonna want to like play the bounce of that fair value gap every single time. You're gonna want to basically kind of use other confluences too. Like, um, how do I say it? Not every single fair value gap is gonna work like this. You're gonna obviously use like confluences as well. But let's just get straight to what a fair value gap is. So what a fair value gap is basically three candles right there, right there, and where the fuck is my? They're right there. Not every single candle is gonna have something like this. Bro, this kind of looks retarded. This wick kind of looks ugly too. Not every single candle is gonna look like this. Sometimes these wicks cross, so sometimes you'll have something like this. Um, this is kind of ass. And right here, since there's no gap right here, then this is not a fair value. So this is not it's basically not what it is. What a fair value gap actually is when these wicks are kind of separate. So you have one, two, three candles. You got this first candle and you got this third candle right here. This is your gap right here. That's your gap. And yeah, this middle candle is kind of like the body and stuff like that. And yeah, that's your fair value gap. Um, that's what you basically play off of. Obviously, this is not a fair value gap. Right here, you can see these wicks are kind of crossing. Right here, your first and third, they're kind of crossing, so that's not a fair value gap at all. Let me just erase this bullshit. All right. So that's a fair value gap, and the whole like idea of people playing fair value gaps is basically they're trying to look for entries. So right here, you have like orders that aren't being filled. Right here, we just kind of shoot up a little bit, right? And then price kind of wants to retrace back to this fair value gap. So right here, the whole idea of like how these fair value gaps are basically played is just price kind of retraces to here, kind of gets like some movement going on over here before we kind of push up again. So right here, this should be your entry. You could take a long like this. Obviously, use other confluences. Don't just be doing this shit just because you see it. But yeah, I'm just trying to show you guys like an example of what I mean. Um, this fair value gap will only be invalidated if you get a candle close right here. If you get a candle close on this fair value gap, that's called an inverse fair value gap. And I'm gonna show you guys what I mean in a minute. But yeah, the overall idea of when you see a bullish, this is obviously you going to the upside. This is bullish. And this is considered a bullish fair value gap. You're going to want to get a retrace in here, place your entry, and then target basically highs or continue higher. All right, that's that example right there. Same thing if you were bearish. So let's give you an example to the downside. All right, so right here we have this little downside, right? All right, now we have this downside fair value gap. Since my shit moved a little bit, we could kind of connect these. All right, now we have this this downside fair value gap. This is called a bearish fair value gap because we're coming down. And right here we kind of have like a retrace to the upside. Right here we retrace, and then we just come back down. We get some more orders filled in right here, and then we come down. And then again, if you were playing shorts, this will kind of look something like this, bro. It'll look like this, get your entry right there, have your stop loss, candle close above here, and then boom. That's how you'll play something like that. And then I'll show you guys in the actual charts what I mean. Right here, perfect demonstration of what I mean. Um, Obviously you have this fair value gap that got created, it got inversed, but I'm not gonna wanna always take a entry, something like that. You're gonna use other confluences too. Right here we kinda create a fair value gap right here. What does price do? Price retraces back to the fair value gap, and then boom, we push higher. So say if you were to enter, your longs would look something like this. Your longs would look something like that. Candle close right there, and then target previous highs, which will be here. So we come down, target up here, and you can see we kind of do come up before we have this downside. This little pullback down here, or not a little pullback, this is looking kind of like a strong pullback, but we actually do end up recovering. Then we actually reach our take profit, and we come back a little higher. This will be a entry if you were trying to uh, play the upside. However, we could also show a bearish fair value gap, like right here. We see price coming down. We see this little downtrend kind of forming. We see this 1, 2, 3 fair value, this 3 candle, and we have this fair value gap right here. All right. We see price coming down right here. I'm probably gonna use my arrow. We see price. So this is your first candle, second candle, third candle, and right here is your gap. You see right there, that's your gap. Price kind of retraces into here, and what does it do? Fills some orders, and then comes down. 1, 2, 3. Plain and simple. All right. And look, you then take out these lows right here. You take this low, and then this low. So say if you were to short this. I actually did short this. Your entry would have looked something. I'm pretty sure I shorted this somewhere right here. I think my stop loss was a bit higher. But yeah. Then take profits right here, here, and here, wherever you want. And you can see price kind of takes out these lows right here, here, and here, because price is attracted to basically liquidity. And what is liquidity? Basically just these spots. I probably should explain that in another video, but yeah, basically your lows right here. You have your low right here, low right here, low right here. I actually call this sell side liquidity. So you got this sell side, but for the sake of me trying to sound simple, I'm just gonna call these lows. You could hit this target, and this target. Alright, we can see these get taken out. Now we could focus on basically trying to catch an inverse. What I mean by inverse, basically a reversal to the upside. And that's how you basically play those type of things when you're trying to come down. But when you're trying to come down or when you're trying to come up. So right here we come up, come down, push up. Right there on my example that I showed you, where the fuck is that shit? Right there we came down, pulled up, dropped down. Alright, now I want to show you guys what a inverse fair value gap is. So what if inverse fair value gap is basically something like this, right? And the way I play these inverses is when I want to play these inverses. So I'm expecting for a fair value gap to get inverse because I'm looking for a potential entry to the upside. So I'm not gonna um, basically short every single time I see something like this. there's obviously other confluences too. So I'll show you guys what I mean. Because obviously when we come down on this day, on Friday right here, Friday we came down, came down, came down. I wait for a reversal. So this is what I wait for. This is what I wait for. And then I look for signs. So I look for a fair value gap, and I wait for that to get inversed. I wait for it. I don't I don't expect something like for it to come up and then come down. Obviously you could do that too. But since for this strategy that I play all the time, not all the time, but like when I see it, this is later on the day. But when I see it, I'll be looking for for a fair value gap to get inversed. Once it gets inversed, we could basically play the reversal to the upside. Same thing if it was the downside. Right here, this and that. I probably should explain what an inverse fair value gap is. But what an inverse fair value gap is when you bro, I kind of sound like a teacher at this point, bro. Is when price comes up, right? Um, we have this candle, and then it kind of closes above. From there, you call this your inverse fair value gap. So this used to be a fair value gap, but now it's called an inverse fair value gap because it got inversed. You got to kind of close above, and boom, you can basically try playing the upside. Or depending if the setup is right, you could play the upside. Um, Obviously, it's not the first candle that comes. It might be like the second candle, or like the third, or like the fourth, or whatever. But I'll be trying to look for an inverse when I'm trying to play the upside. And my fault, my mic kind of glitched out. And I'll show you guys an example of what I mean. Um, oh, I should probably show you guys an example of an inverse fair value gap if it was to the downside. I mean, from the upside to the downside. And this is from the downside to the upside, which I like playing this because it's more funner. Obviously, I also like catching the upside to the downside reversals, but I don't know. All right, we have that kind of looks like ass. That shit looks like ass. All right, trying to get you guys understanding more of what an inverse fair value gap is. All right, right there. This kind of looks like pretty shitty, but we're uptrending, right? We're uptrending, and we kind of wait for price to kind of just stop trending a little bit. And I'll take the once price kind of stops trending, I'll take the first fair value gap, and I'll wait for that fair value gap to get inversed. So right there, one or two things could happen. So if I'm trying to catch the reversal again, um, I'm waiting for the first fair value gap to get inversed. I'm not waiting for it to be to bounce. If it bounces, then I'm gonna keep waiting for the inverse. I'm gonna keep waiting for the inverse. We might create another fair value gap if we keep going down. So say if fuck, let me just explain what I mean real quick. Say right here, we come down, right? Oops, I didn't want to use this. It was supposed to be my brush. So right here, we come down, right? I'm waiting for a candle close to the downside. Right there, right there. I'm waiting for that to get inversed. And then once this inverses, it could pull back a little bit and then we could follow the downside. Sometimes it might bounce again. It actually might bounce sometimes. Sometimes it'll pull something like this and boom. And when it does, then it does. But I'll just wait for this fair value gap to get inversed again. It'll only be inversed if um, you get a candle close. So if you get a wick, it's not inverse. That's still a fair value gap. If you get a wick, it's still a fair value gap. But once you see a candle close, or basically candles start closing and stuff like that, then that's an inverse fair value gap. Obviously, if you don't, then yeah, that's the fair value gap. So this will still be called a fair value gap, and we might continue higher, and this is where I probably see price kind of drop a little bit, and then it could fake me out and actually go a little bit higher. We might create a new fair value gap, and I'm just gonna want to take that fair value gap and wait for that one to get inversed. So say we do go up, right? So we do go up right here, right? So we do go up, right? I'm no longer waiting for this fair value gap to get inversed. I'm now waiting for the recent one to get inversed. So I'm now waiting for basically this one to get inversed. I'm waiting for this one to get inversed to catch the downside. Same thing if I was playing the upside. Say this one doesn't get inversed. Say it comes down. Or say it did get inversed, but it gets down a little bit more. Um, then I'll just wait for that fair value gap to get inversed and just wait for like a little bit more indication. And yeah, if the fair value gap gets inversed with volume and if it holds, then we could see the reversal. So yeah, basically stuff like that. I'll take the recent. So sometimes you have like multiple and you're like, which one should I wait for to get inversed? Me personally, I'll wait for the first one to get inversed. So you see you got this fair value gap, this fair value gap, and this fair value gap. And you're like, which one should I wait? Which one should I wait for? Just take the first one. Because then this will make more sense, right? Like look, right here, say if you were to enter. Once this gets inversed, you have your stop loss basically closed right there. Something like that. Obviously some gaps don't look like this. This looks like a lot. When you're trading options, there's like a lot of red. But if you trade options, you'll be banking off this green. But this makes more sense to enter off the recent. Whereas if you enter right here and you're trying to get it kind of closed back right here. Me personally, I'll take a trade like this. Unless you want to do something like this, but then this doesn't kind of make any sense, you know? Because then you'll probably be stopped out. Where this will probably make more sense. Obviously, right here, fuck. You guys will know what I mean in a minute, bro. Obviously, these drawings are kind of bullshit and shit like that. Um, but yeah. Now I'm gonna go over basically what I mean. So right here, we have this fair value gap that actually comes up, retraces, and we go up. So this fair value gap was created. We come down, price targets this high. We take out this high, and now we have this new high. We have that new high. So we kind of get rid of this high and stuff like that. Now we have this new high. So what we could do is basically try catching something like this, a reversal to the downside. Obviously this is around 1120, so yeah, you could try getting a fair value gap right here. Try waiting for price to kind of retrace to try coming down. It kind of did retrace and it kind of went down. It came down with a little bit of consolidation, but yeah, right there, you kind of push up, stuff like that and stuff like that. All right, that's like an example of like fair value gaps. Now I'll show you guys an example of inverse fair value gap. So right here, we have the high, we have the low right here, which is down here. I could show you guys in replay mode. All right, so you guys could try doing this on a 3-minute or 5-minute, stuff like that. The thing is, when you're trying to catch reversals on the lower time frames, you're gonna get spotted. You're gonna get like a little bit faked out, a little bit, just because sometimes this could look like a reversal, or that could look like a reversal, or this could probably look like a reversal and stuff like that. So a way you could kind of basically not get caught in something like that is just go on like the 10-15 minute. Go on the 10-15 minute, wait for price to basically stop. All right, we got our first fair value gap, right? So what I mean by waiting for it to stop, wait for it to stop on whatever direction it's going. So right now I'm gonna show you guys what I mean. So right here we come down, downtrend, right? We stop right here. We have our first fair value gap right here. First fair value gap. And what I'm waiting for price to do is not basically come up and then come down. What I'm waiting for price to do is actually get inverse. So I'm waiting for this fair value gap to get inversed, which is what it did. Right there, it inversed. What does it do? Pulls back a little bit and it comes up. And what does price do? Goes up, goes back to the fair value gap, goes up, hits that. So it eventually reaches this high a day. And yeah, basically that's how I catch my reversals to the upside. Um, I think I caught one on news as well. Right there, I caught something right here. Right here, we had this downside. We had this fair value gap right here, right? And I think I caught this on a smaller time frame. Yeah, we got that fair value gap that got inverse. We inversed it, and then we come up 1, 2, 3, 4, couple candlesticks. So right there, what was it? Right, we opened up here, and we had our low right here. We had these lows basically taken out right here. This low did not get taken out, but yeah. After this low was taken out, I'll probably erase this. After this low was taken out, then we have this one right here. Yeah, this fair value gap. And what I'm waiting again, I'm not waiting for price to basically uh come down. Like right here, we come down. And I'm not waiting for this fair value gap to basically be a fair value gap. I'm waiting for this to basically inverse. So once this inverses, then I'm gonna want to play the upside. And that's what it does. That's how I catch my reversals to the upside. Um, it all depends how you want to play. Obviously, sometimes we're downtrending and we have a fair value gap. I'll use my first fair value gap to basically enter on a downtrend. I'm not going to want to be entering a fair value gap like as I'm downtrending. If that makes sense. So right here, I'm going to explain when we come up and then we create a fair value gap and we actually come down. All right. So right here, we have our range again. We have this low, we have this high a day. Right here, we come down, we come up, we're kind of consolidating. I did take a call on the upside a little bit, and I took a put to the downside, but it was kind of choppy a little bit. The reason why I placed calls was because we had a gap up, right? We had a gap up, and price kind of retraced in the middle right here. I entered in calls because we didn't uh, go underneath the middle of this gap up on the when we opened, right? If price were to basically have some candle closes underneath the middle line right here, then I'll probably look for potential shorts or retrace back and then short. But since price kind of came down, didn't get a candle close. We did wick off of it on the 10-minute. On the smaller time frame, we did have some candles kind of laying right here. So right there, I entered in calls and then took something like this, and it was kind of wonky a little bit because right here we do have like these candles kind of like consolidating, but we do end up taking the high of day. And then once that high of day was taken, we could either have a candle close above, like the next candle close could basically hold us up. Unfortunately, we did have a candle close right here. We started seeing candle closes above the high of day. I mean, we started seeing a candle close under the high of day. So under this high of day, I look for a short. So what I do, push onto smaller time frames, see if I could find a fair value gap to look for a reversal. Right there, what I see, a fair value gap right here. This is called a fair value gap. But then price, what does it do? It inverses. So now this is called the inverse fair value gap. And then right there, we also see like, let's remove that. We also see 1, 2, 3. We also see a bearish we see a bearish fair value gap, right? We could also use this as like another confluence. So we could call this a fair value gap next to our inverse fair value gap. Right there, we have two fair value gaps stacked up. We could use this as double support. This is our entry. Right here is our entry. Right there is your entry. Target all these lows. Target this low. I'll probably, after this low, I'll probably target this low, or I would target this low. Then I'll target this low, and then target this low. But I'll probably be taking out all my profits after this low right here. And you can see how this trade could kind of work out. Obviously, if you want to take out these lows as well, then you can. You can feel free. But basically, that's how I'd be using my fair value gaps. Um, if I'm looking for a reversal or when I'm trying to flip sides, I'll wait for a fair value gap to get inversed. Um, but if I'm looking for, say I'm trying to follow a trend, right? The beginning of a trend, I'll look for an entry. So before a trend starts, right? Say right here. Oh shit, I could also show you guys with these arrows and stuff. But say again, right? All right. Say we're creating higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, higher highs. Say you want to try following this trend that's already like made enough higher highs and higher lows. Say you wanted to get a fair value gap. Like say you wanted to get, oh fuck me. Say you wanted to basically enter in this. I would not personally enter a move that's already happened. I'll wait for basically the reversal. So a lot of people, what they would do, or a lot of new people, what they would do, they'll see a fair value gap somewhere right here, and then they'll be like, oh, it's probably gonna bounce. So they'll wait for the retrace. And this is why I think it's a little bit more better to kind of catch the downside after um an uptrend, like after we come up, right? So some people are expecting this and then this and that. And then yeah, you could do that. You could do that. But what I'll do is be a little bit more patient, wait for this fair value gap to kind of get inversed, and then catch the downside. I'll have this target, this as my target, this as my target, this as my target. Because this right here, you have more to basically make. You have more to basically make. And a lot more to run, right? If this inverses. You have basically a lot more to run once this inverses, right? Oops. So once this inverses, it's going to pull back a little bit, and then you could target all these lows because price is basically attracted to liquidity. This right here is liquidity, this right here liquidity, this right here liquidity, this right here liquidity, basically previous lows. Um, but people call it liquidity because they're fancy as shit and they want to make trading complicated, but I just call it previous lows. Um, yeah, basically try taking out these lows to make new lows and take out highs to make new highs. It kind of sounds dumb, but when you put it together, everything kind of lines up. Um, but yeah, I'm just trying to show you guys how I play my fair value gaps and stuff like that. I'll probably make or I am gonna make another video of basically what I mean on my strategy when I try playing fair value gaps. So say right here again, we're uptrending, right? I'm not gonna wanna wait for price to come down to this fair value gap and kind of continue higher because what comes up comes down. Once a move happens, I wouldn't want to enter a move that already happened because one or two things. If you enter a move that already happened, we're probably gonna continue up. You could continue up, but you're gonna have to expect for us to come down a little bit because yeah, price wants to come down. Right here we see we kind of come up. But the move actually happened right here on this reversal. And this reversal is what I actually caught. I'll show you guys right here. So right here, we have this right here and we have this right here, right? Looks better on the bigger time frames. So you could catch these moves way better. This looks way better on the higher time frames, which is why I use the 10-15 minute to catch my reversals. Again, right here we have this fair value gap. Gets inversed. And smaller time frame, 5 minute. Right here we see we kind of pull back. We pull back down, and that is basically our entry. We basically come back down a little bit, and then we continue higher. And then we also have these fair value gaps as well. We inverse those, we inverse this one, and then we kind of drop down a little bit and we come up. So these fair value gaps could also be inversed as well, and you could hold your trade a little bit longer. Also on the EMAs that we have right here, we have our candle, not candle, but we have our crosses basically crossing. So right here, our EMA is crossed, and once these EMAs cross, we could hold our trade for even longer, target these highs. And me, I was all out on these highs right here. I didn't want to take this, but we did actually end up continuing higher. Right here, we actually didn't end up uh, basically coming up from here. So we took out these highs right here. Took out this high, and I think this high was taken on this same day. Yeah, basically those highs were taken out, and now, yeah. But for me, I was only targeting this high of day, and yeah, you could also take out these. But yeah, that's how I catch my reversals. Inverse fair value gaps, and if I'm trying to follow a trend, then I'll use fair value gaps to take my entries. That's if it's the beginning of a trend. um, fuck. I want to look for another example, but it kind of just shows. So right here, we see this downtrend, right? And some people are probably going to want to enter on a fair value gap, like right here. They're going to want to enter on the fair value gap right here, right? And you could do that. This was basically my setup, kind of. Or was it? This low was taken out. This low was not. This low was taken out. Yeah, so this. Wait, I gotta look at my bias. Alright, whatever. But let's just use what I told you guys right now. Say if I wanted to catch a reversal to the upside right here, I would have been stopped out. I would have been stopped out. My loss would be very minimal right here once that candle closes. And target that. So my stop would be basically right there. I'm pretty sure this candle closed on the 5 minute. But yeah, once you see a candle close on the 5 minute or whatever minute you're on, but once you see a candle close on this fair value gap that you're waiting for it to get inversed, which actually did get inversed, this invalidates the setup, you know? And you could take that as a loss. I would take that as a loss. But say if you were trying to play the downside trend, like in the beginning, like sometimes in the morning, I'd look for a range and a breakout of the range. And basically, I'll look for a fair value gap to basically try following the, not following, but try playing the breakout and try catching a trend. And this is how I catch my entries to a trend. Obviously, the trend isn't there yet. You'll see the trend as soon as it's formed. Um, I personally use my fair value gaps. I'll use the first fair value gap to try entering in a trend. So right here we come down, we retrace into this fair value gap and we come down. Again, we try retracing a little bit, but we come down even lower. And from right there, we'll already be taking these lows right here. Taking this low here, taking this low here. And yeah, we could take this low as well. Look that low right there. Boom. Targets get hit. Target get hit. Target get hit. Target get hit. So unless I'm trying to follow and enter the beginning of a trend, that's when I'll try playing like the bounces, the fair value gaps. So right here, we start this trend. Obviously, I don't know if it's a downtrend, but right here we do have a break of the 15-minute range, right? So the 15-minute range is probably somewhere right here, right? We do have a break on this 15-minute range. We have a fair value gap. We kind of pull back a little bit, follow this downtrend to the downside, right? And that's how I play like my breakouts of my range. And that's basically an example. So I'll use like the first fair value gap. I'm not gonna want to be playing this shit. So we already see this downtrend being clear as day. I'm not gonna want to wait for something like this. I'm not gonna want to wait for this and this to happen. Sure, this played out, but this is more like not my trade style. But I'm hoping you guys understood or what a fair value gap is and how I use them off basically my ranges and like my strat that I basically played, which is just taking out highs and replacing them with new highs and then taking out lows, replacing them with new lows and try catching the reversals. Um, Basically, again, to get from this lesson, um, fair value gaps if you're trying to catch the trend, like entries to a trend, and inverse fair value gaps if you wanna catch the reversal. You're gonna wanna obviously get a fair value gap and inverse it. Right here, we got a fair value gap, inverse, reversal. Probably not the fanciest one because we came down a little bit, but we eventually uh, played out. But yeah, if you guys have any more questions, just let me know. I'll be glad to help. But yeah.